Wednesday, 9 October, first critical price points. With the weekly chart, the daily chart, these upper price points are determined for the session day high or daily high, and then we have the lower price points and the daily chart. These are important for later on, as you can see in here, the weekly consequent encouragement of that, and then we have the daily consequent encouragement, which is all important later on for the PM session to trail potential stop losses. But what's more important for now is the entry model, is that this wick, this daily wick, why is that important? We measured that, we see minor sell side is being taken, the consequent encouragement of that is being protected, then this wick is being divided. Today we had an 8 handle opening an inch gap. We can see all these things that are very important later on. Then I want to take your attention to this today. Why? Because we have reached all-time highs in different price points, and it's just important. If we measure this high till this low, then one standard deviation of that, that's the all-time high, and we closed above this candle, but we do close below the weekly CPI, and we don't fill in these this daily CPI all the way down, so we still have some potential to trade down to the lower, to these lows, take those out first and then rally higher. But we can potentially also see a very, 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 very big range day tomorrow and Friday to then trade to the daily the all-time high, excuse me. Now we have the entry model. I'll explain this very thoroughly. Don't forget that this is the daily consequent encouragement, which I annotated in the beginning. Now with the price delivery, we have the E-mini, we have the S&P 500, the Nasdaq, and then we have all-time high with the Nasdaq already being taken. Today we took the primary buy-side liquidity, and we did that also with the S&P. We already did that yesterday, and then we took primary sell side, and then with the Dow we also already took primary sell side. We didn't take all-time high yet, so this could be an indication for the SMT, for the fall SMT. So that could be the high of the year now, and this could be then the market structure shift in here, and we don't really need to see at this point in time now trade down to the primary sell side, but I could be wrong tomorrow. Tomorrow we could trade to the all-time high and then trade lower, or we could leave a relative equal high and then trade all the way down to primary sell side and then take these these relative equal highs, because there's a lot of orders resting in here. So then we have the entry model. The low of the day is the consequent encouragement of the daily wick. We find support in here, so we wait till 9:50 till 10:10. We finally inverse the first percentage fair value gap. Once the trade back into that, we see we do that with an inefficiency, trade up higher. We do that with inefficiency, so now we can trust this first percentage fair value gap. If we didn't do that, we traded up and then traded immediately down again, I would not enter. But since we did it with an inefficient market, we trade lower, and then once we enter in here, we expect to inverse this fair value gap. Once we do, we have a breakaway gap, and this candle here, that's where my entry was, but I could have also entered inside of this macro and then rally higher. We have a breakaway gap, and we trade down to the new day opening gap high. As you can see, the bodies are respecting that. We trade to the midpoint of that. That could also be a pyramidal entry. And we trade higher. While doing so, we have a 50-minute fair value gap. We trade up till this. This, by the way, was an SMT. We took this buy side on the ES. And then in here, we trade down, we inverse this fair value gap. And why do we do that? To trade back into the 50-minute fair value gap, we fill that up, that inefficiency. We see this order block, the consequent encroachment of that, we trade down into that, we turtle soup this, the bodies are respecting the 50-minute fair value gap, we trade higher, we inverse this fair value gap again. We have a low, high, lower, low, higher, high. Then this is the breaker block, this candle in here, and the market structure shift at the same time. Once we trade up into that, we have this as a breakaway gap. Price trades lower to this order block in here, so we can enter on this, as you can see in here, but my arrow couldn't fit this. So this candle, where my cursor is on now, that's an entry. Then we inverse this major inverse of value gap. Once we trade back into that with this candle, we may also enter to then trade up to the high resistance liquidity run, 25% range of the weekly fair value gap, and the daily consequent encouragement wick. That's where my profit would be. At the lunch macro, we see that the London close, we see that we take this sell side, we trade back into the 15-minute fair value gap, then we trade up. For lunch, I want to see buy side go, and then at 2 p.m. the FOMC candle, we turtle soup this, then we trade higher, we inverse this fair value gap in here. Once we come back in the fair value gap, we trade for a long position, and we put our stop loss below the consequent encouragement of the FOMC candle. So that was it. Yep.